2050 trades. And from 2050 trading with a value divergence, we had a $2,000 per contract swing. Look at where the POC was. Look at where the top edge was. You couldn't make this up. You honestly couldn't make it up. Look at where the POC is. Look at where the top edge is, Peter. I assume you use the dealer keys after yesterday's classroom, everybody. So after yesterday's classroom, where was the dealer key? 20,170. What's today's top price? What's today's top price? 20,170, right? So when you look at the dealer key, a dealer key at 20,045, a bidder at 20,050, bottom edge. We then said that we would have a probable POC. The probable POC in this case would be 20,100. What happened at 20,100? Does that look like a POC developing there? Yes or no? It looks like a POC developing right there, doesn't it? So then if that's the POC, what's our sell price? Our sell price is going to be 20,170. What was the sell price? 20,170. We just gave you $2,000 on the way up, and we've just given you a additional two trades of about $1,000 almost a piece, which is a total value of about $4,000 from last night's tweet. $4,000 per contract from last night's tweet. There's nobody else in the universe that's giving you that type of value if you decide to pick up on it. If you decide to pick up on it. And it doesn't mean we're going to be selling here. It means that we're looking here for possible plays. We're looking here for possible value. Have we had any possible value, guys? Yes or no? Has there been any value to sell that price? Yes or no? Has there been any storyline to sell the 170? Yes or no? So it's not as if it's hidden. You know, the storyline is strong, the storyline is real, the storyline is there, it's visible, it's clear. It's got a great idea about what's happening in this area here. And, you know, obviously it's starting to build between the 100 and the 170. So the fact that it's starting to build in this area suggests that this area is going to become a POC, which means if this balance becomes a POC, then of course that means that the bids move back again to the potentially the 2050 level. It means the offers move up to 190, which isn't that far away. But it means that the next move is probably, realistically, going to be the 2190. And if it takes out the 2190 and accepts that price rather than rejects that price, we may well be moving towards the 2290 level. So we can start looking for that as a storyline, right? So we're obviously acting off of the 100 now as a bid, and we're now selling. So if you bid off the POC, the sellers will do so much at this price, but if they can't get value working, they're going to pull away from the 170 to the next price, which is going to be the 190. And that's obviously going to be an opportunity for you to see what happens from that point onwards. Anyway, it's been one of those kind of days where if you just did the stuff we covered in classroom yesterday, you would have been in great shape. Absolutely sensational shape. But hey, that involved learning stuff and then using it, which I know is a bit of a stretch for a lot of people. But if you're good enough to do that, then you've made some cracking trades already today. So welcome in, guys. Welcome in. It is, of course, US election day today. The odds have shifted a little bit back in favor of Trump this morning. They'd started to drift. We saw that Trump had moved from 1.5 to 1.7. It's dropped back down to 1.57. So, you know, the overnight money seemed to go back on Trump again. So 1.57 on Trump to win, 2.5 on Harris to win at the moment. So slight shift back in favor of Trump. Now, obviously, when we were asked a question actually earlier on today about what does it mean for different markets, and A Trump win is going to be negative gold. I agree with that process. I agree with that story. And the reason why it's negative gold is because it's going to be positive dollars. There's going to be better buys somewhere else on a Trump victory. So a Trump victory is going to be good for the dollar. It's going to be probably bad for gold, and it's going to be good for equities. A negative, a positive for Harris would probably be gold and probably be the euro. So positive euro, positive yen, positive euro, positive the yen, positive gold. They would be the markets I would be more inclined to be looking towards for a Harris victory. Trump victory, long equities, long dollars, and short gold, for example, would be the kind of plays that would make a little bit of sense at this point. So a Harris win, probably negative equities, yeah, for sure. So I think equities, would be the best buy if it was a Trump win. But that's just that's the way it's always been with Democrats and Republicans over the years. That's always been the way that the markets have behaved. Might not be the case this time round, but certainly that's the way the commentators as well seem to be leaning in terms of the outcomes of this election. So let's see what the day holds. Should probably be relatively quiet. Should, I would imagine, be relatively quiet because people don't want to take long-term positions on the basis that that long-term position might last 24 hours. So I don't think there's going to be a lot of money applied to the markets until we know who's going to be in the White House, until we know what kind of budget requirements are. And I think that's another big important point, Jack, actually, is what is this? I mean, a lot of people talk about the politics, but moving away from the politics of it, what are the economics of it? In other words, what is the government spending going to look like? Because this was a big question in the UK, of course, is that the idea that Labour's going to splash the cash has to come from government spending. So obviously that splash the cash on the back of a massive spree of government spending, does it represent value for money becomes the biggest single question. Does it represent value for money on splashing the cash? It's obviously short-term GDP positive, so we know that that's the case. As soon as you splash the cash, it's effectively fiscal easing, not monetary easing, but fiscal easing. You get a lot of cash coming into the system. Now, if it doesn't return money, then of course it's money badly spent. If it does return money, then it's money well spent. The challenge a lot of people have, of course, is the government the best place to spend your money? And I think history shows that usually the government is the worst place to spend your money because they spend it on usually a big pile of crap most of the time. So that's the challenge. When we see what the Fed believes is the spending process, depending upon who wins the next election, is it going to mean more trillions of dollars for US debt, which it means for the UK, for example, when Labour became, the election winners? Of course, what that meant was that UK debt would be expected to increase significantly, and that's why they started to talk about higher yields for longer, because obviously the demand, the amount of supply coming in from the UK Treasury was going to have to increase to accommodate this new spending. Well, that obviously means that you're going to get higher interest rates. Higher interest rates can lead to, of course, this idea of, higher mortgage rates, higher borrowing rates, higher cost of living and all that kind of stuff as well. So there is a balance. What has to happen for a successful government to do that is to turn that public sector money into proper growth, not just short-term purchased growth. It's easy enough with the COVID money, the helicopter money, to have that short-term splurge of cash. It's inflationary in the short term, but it causes absolutely nothing. It develops nothing. It develops into absolutely nothing going forward. So public spending has to have an outcome. It has to have a positive expectancy. And I think the problem we've got with people in government is that they don't really think about that. They don't think about the positive expectancy going forward. And they just want to win votes, basically. And that's the problem. That's the problem. So, a lot of the spending, if it has a good reason, has a genuine chance of developing out. So when you spend the cash, it should bring money back into the system. It should bring in American jobs. It should bring in British jobs. It should be good for Britain. It should be good for America. It shouldn't just be going out on foreign aid. It shouldn't just be going out on funding more wars. It shouldn't just be going straight back out the door to fuel even more outside money. It needs to be in the country, and it needs to be accelerating cash round the system, because it's a good way to get money accelerating so long as it has a longevity attached to it, not just a quick fix. Anyway, welcome in. We'll soon know all about that as we go forward into the election itself, and we'll see where the money starts flying in terms of Fed funds rates, in terms of the tips expectancies, and in, of course, in terms of the bookmaker odds going as well. So let's see what happens. Anyway, welcome in, guys. In terms of data that we've seen so far today, of course, as I said, it's going to be one of those kind of days. But we did get quite an important UK PMI out already this morning. Let's cover those numbers very quickly with you. So you can see that the UK services PMIs come in very strong at 52. The global PMI composite also 51.8. So two good numbers there for the UK. Short-term growth is good, and that's a good number. And moving forward, we can obviously see that we also have the small matter of some US numbers here as well, non-manufacturing PMIs and the like. So 5th of November, 5th, remember. And we've also got something interesting coming up tonight. It's the 10-year auction, which made the auction the other day quite important to us. So we were obviously wanting you to practice. I'm not sure how many people did practice. I never got any messages from anybody that said that they had traded the auction itself. I didn't get any messages from anybody telling me they had played the auction. No messages from anybody saying that they'd done well on the auction. No messages from anybody saying that they'd read the auction perfectly and they'd made a lot of money. And, that's disappointing, because we thought that everybody was going to be starting to practice this. Because obviously what happened was that there was a very, very nice, easy profit of $300. So what was the trade? Well, the trade, of course, you can see the high yield was 4.152 or 415.2 versus a when issued of 414.3. So in other words, what's happened? Well, you can see that it's a bad auction. The high yield is higher than the when issued, so that means it's a bad auction. That means you should have been straight in to sell the bonds. Straight in to sell the bonds, everybody, yeah? Straight in to sell the bonds at 6 o'clock. So if it's a straight in sell on bonds at 6 o'clock, we're obviously going to be looking for that as a trade outcome. We're going to be trying to be short the Treasury. And this is what happened on the Ultra Bond from 6 o'clock. You can see that 6 o'clock came in here. There's 6 o'clock there. 6 o'clock came in. The price halted. The price hovered. You can see that there's a lot of selling coming in against those buyers. Yeah? A lot of selling coming in against those buyers. And obviously, the trade dropped beautifully for $300 without any real trouble, without any infringements there. And then obviously a Charlie D reversal to exit the process here. And you could have done some pretty good money, which is quite nice, had you decided to practice it. Then, of course, had you decided to practice it, you would then be prepared potentially to take a look at the 10-year. If you haven't practiced it already, then you can feck off. You can practice the 10-year and then you'll be ready for the next one, because you're not ready yet. You haven't practiced it. You haven't done any work on it. And a lot of people that try and just jump straight in, they end up making mistakes. They get disheartened by it and they don't then do it properly. You've got to practice. If you haven't practiced, you ain't doing these as live trades, guys, because it's stupid. It's dumbass trading to trade something if you haven't practiced it already. You need to practice these things. And taking that 3-year from the night before allows you to practice it. It allows you to know what you're seeing quickly. It allows you to work on your skills. It allows you to demo trade it. You can see whether you would have played it. You could have figured out whether it was good enough. And obviously, you might be arguing that the stop through or the tail is big enough or small enough. You don't know that until you try it. You don't know that until you've practiced it a few times about what is good and what is bad. In this case, the actual tail on this was at 9 points. The previous auction, remember, was a 20-point stop through. So you can obviously recognize the numbers mean a lot. 9's okay. It's not going to be a big winning trade. $300 is obviously a small win, but it's still a win. So we've talked about this before, that when we did this bond classroom, we said that you can make a career out of these auctions because you could actually focus on just doing these auctions at 6 o'clock on the US auction day. And that could be your career in bond trading, and that is it. So let's see how today's play out. Yeah, I mean, if you're going to trade some money, though, Oliver, you're not going to make very much. I mean, we suggested the T's and the F's just because they don't make much and they don't lose much. You can't get it terribly wrong. But if you're actually going to trade the auctions, you should always get onto the UB contract or the ZB, because it's the only way you're going to actually make some reasonable money out of these auctions, is if you play the big back end of the curve. Anyway, so as I said, welcome in, guys. In terms of data coming up for the US session, we've just touched on it. We do have the small matter of the trade balance coming out in just 5 minutes. We also have the final services PMIs at 2:45 London, 3 o'clock for the ISM services this afternoon. And then that is us, guys. That is us for the day. You can sit back, get the Cokes out the fridge, get the Budweisers out the fridge, and look forward to the US presidential coverage in the overnight session for what it's worth. And then we'll see what the damage is when we hit the markets tomorrow. Anyway, welcome in, guys. Going to grab some lunch, and then we'll get started.